So we live in a market-based economy. In this economy, broadly speaking, it's an economy dominated by supply, demand, and price. These are the main things that cause big levers to move in our economy. And as Jim Yong Kim, the former president of the World Bank, says, there has never been a global movement to put a price on carbon at this level and with this degree of unison. By placing a price on carbon emissions that reflect the cost, the damage they impact our society with, it provides a disincentive and an incentive for companies to find low carbon options to manufacture their product. And so this is a key lever in a market-based economy in which we live. We must put a price on carbon. Today, if you build a factory, you build your product, you emit carbon dioxide. In many countries, those emissions are not priced. It doesn't cost you anything. You can pollute for free. But as we've seen, those emissions do have a direct economic cost. And therefore, there's now this movement to put a price on carbon emissions. The World Bank has produced this. There are two ways to price carbon emissions. One way is to tax carbon emissions, and the other way is a cap and trade system where emissions are capped and the underlying companies can trade the carbon. You can see the yellow bar on the graph here. That is China. China is launching later this year, Corona notwithstanding, the largest emission trading system in the world, covering 3.3 billion tons of carbon dioxide. And when that comes on stream, you can see on the left, on the y-axis, approximately 20% of emissions on the planet will be covered by some type of carbon price, either a carbon tax or a cap and trade. Now, when we talk about carbon markets, there's a lot of confusion. And I want to try and clear this up because many people confuse the different carbon markets. The first thing is to say is that there are three distinct and separate carbon markets. The first is the compliance carbon market, which I'm going to deal with separately in detail because that is the market in which we invest. It is highly liquid, highly regulated, and very large in size, trades 1 billion per day. But I want to provide some information about the other carbon markets because often investors get confused between these different carbon markets. So on the far right is what we call the voluntary carbon market. This is what most people are familiar with carbon. This is where you buy a carbon offset by investing in a project, normally in a third world country for perhaps planting trees. It might be for clean cook stoves, where a project developer will calculate the potential carbon emissions reductions from the project. That will be approved, and then they will develop the project and they will sell those carbon offsets. That market has some very well-meaning people. It is growing because more corporates want to offset their carbon footprint through investing in these projects. And many of the projects have very good co-benefits. For instance, they will often not only plant the trees, but build a school for the children in the nearby village, provide sanitation, etc. These kind of excellent co-benefits. That market, however, is quite small, perhaps about $300 million a year. It is growing though. It is largely unregulated and there is no liquidity. When we think in financial terms of liquid markets, this market has no liquidity. So that is the voluntary market. The middle market is the international carbon market, or we sometimes call that the United Nations carbon market. Under Article 6 of the United Nations Framework Convention on Climate Change, a mechanism was developed to allow countries to invest in carbon mitigation projects that would help them meet their commitments under the Paris Agreement. Now, that carbon market, that boomed during 2005, really until the financial crisis in 2008. And since then, that market has really been in abeyance. It's kind of in suspended animation today, although at the next annual conference of the parties, which is the large annual conference of United Nations representatives, they are hoping to reinvigorate that market and engage it so that countries can begin investing in projects to meet their commitments under Paris. But that market is currently, let's call it, frozen or slightly in abeyance. And then, as I mentioned, you've got on the far left the compliance carbon market. This is a highly regulated market. It's the cap and trade market that certainly that we deal in. It's very large, trades $1 billion a day. There are exchange-listed derivatives, futures, and options on the market, and it's very, very highly regulated. I'm going to talk a little bit more about that now. So how does an emission trading system work? It is a market-based policy, and the objective of the policy is to cap and lower emissions. So I'll just take you through the economics of a cap and trade system, and hopefully it will make sense. The objective is to reduce emissions at the lowest cost to society. So in a carbon market like in Europe or the California market, any entity that has emissions above a threshold is automatically included in that market. You don't have a choice, it's law. So we call that mandatory. It's mandatory participation. The total emissions in that market are capped, and carbon allowances, the certificates, are allocated and auctioned to the underlying companies. And typically these are the big emitters in the economy. So for instance, in Europe, we have about 13,000 entities in the cap and trade system, and they cover about 50% of the total emissions in Europe. Each allowance permit allows the emitter to emit 1 ton of CO2, and those entities that are participants are very tightly audited every year. They must submit certificates every year in the year following the emissions year after the audit. If they emit 1 million tons, they must submit 1 million allowance certificates. If they do not, they are fined. And in Europe, the fine is 100 euros per ton. And of course, the current price in Europe is about 20 euros per ton. So all these entities do comply. The other interesting thing about a cap and trade market is the trading side. The entities trade the allowance with each other. And as I mentioned, Europe is a very liquid market, trades 200 or 300, 400 million US dollars per day between futures, options, and physical carbon. And by trading the carbon between them, that sets a market price. So one of the things that an emission trading system has that we like is it is a market-based mechanism rather than a fiat diktat of a carbon tax. Every year, the total supply of carbon is capped, and that cap is lowered every year in most markets by about between 2 and 3% a year. So this gives us the first good thing, which is environmental certainty. It means we know emissions must come down because the total emissions in the region are capped, and every year the cap is reduced. And the elegant part of an emission trading system is that because the underlying entities trade the carbon with each other, different companies will have a different abatement cost. In other words, they'll have a different cost of carbon at which it makes sense for them to look at a low carbon option. And therefore, by removing the supply every year, it means someone in the system must abate, they must reduce emissions or stop emitting. And the trading means that the invisible hand of Adam Smith allocates those permits in a way that the reductions are achieved at the lowest cost to society. This is a very, very important benefit of an emissions trading system. The final thing is that when you have a liquid price on carbon, it fosters a huge amount of innovation because it provides a pathway to monetization for entrepreneurs, for scientists who can figure out ways to decarbonize our economies. They are motivated to do that because there's a large financial incentive to do that because there's a liquid carbon price, so they can monetize the development of a technology. And this is perhaps one of the most interesting things of why a market-based solution to climate change like cap and trade has been successful and is now spreading around the world. And this schematic sort of illustrates that. The dotted yellow line is the cap, and that cap comes down every year while the underlying entities can trade the emissions between them. So we achieve the environmental certainty. We know that emissions have to fall. They must fall. And we have a high degree of confidence that that's being done at the lowest cost to society.